Good evening and welcome to Your Money, Your Call. I'm Chris Kimber. Joining me on the show tonight are Kim Slater from County Securities and Roger Montgomery from Roger Montgomery. Waiting on from Adelaide. Hi Jane, how can we help you tonight?
Hi, I'm just wondering if I could have the panel's view on Cardno, please.
Yeah, listen, thanks very much for your question, Jane. Cardno, we get that every now and again. Unfortunately, still not one of my ones, so I'm going to go to the bloke with the laptop. I'm sorry, Rog.
You got the hospital pass, mate.
Many years ago, I met this company with David Paradise, and they came into David's office and we met them together. And I was impressed by the management team of this company. I actually thought they were the smartest guys I'd ever seen on a board. So I think they're a great business. They're definitely an A1 or A2 business. And they're trading at a discount at the moment to intrinsic value, which I estimate to be at $5.24. So I think they tick all the boxes at the moment, but in this market you just don't know whether or not they're going to get cheaper.
I'm going to go straight to Barry from the Gold Coast. Hi Barry, what's your question for us?
Hello mate, thanks for taking my call. It's just a question for Roger regarding the ANZ Bank. What's a good entry level and the intrinsic value of the bank? And also a trading strategy to accumulate more shares, apart from the obvious buy low and sell high. If you could help me with that, mate.
Great. Listen, thanks very much for your question, Barry. First of all, fat profits, buy on ANZ, come dividend first week in November. Very happy to buy that at these prices. I think grossed up 11% the next 13 months or something. What do you think, Roger?
We own ANZ and the Commonwealth Bank. They're the two banks that we like. We think all the banks are trading at a discount to intrinsic value. Some of them are trading on price to book 1.5 times. If you could get them at 1 times, that would be awesome. I think I've seen that once before or twice before in my lifetime, in the very early 1990s, and again during the GFC. So look, I think the prospects for banks in Australia are probably not as bright as they once were in terms of growth. But 40% of their funding now, I'm speaking for all the banks, 40% of their funding needs is wholesale. 60% of that 40% is from offshore markets, and that's where everyone was really concerned. But the requirement has been coming down, so their requirement to actually fund in volatile wholesale offshore markets is actually much less than it was during the GFC and prior to the GFC. So while everyone's concerned about volatility in offshore credit markets because of Europe, I think it's less of a concern for the Australian banks now than it was in the past. Nevertheless, these things are going to trade with market sentiment. They're at decent discounts to intrinsic value now. We live on an island. You can't escape their fees. I think they're terrific.
David from New South Wales, thanks for waiting on. What's your question for us?
I'd just like to know what the panel thought of Saracen and whether they thought that it would do any good in the coming years. I know it's only a small mid-tier gold producer, but just wondered what their thoughts were.
No, that's okay. Listen, thanks for that, David. Look, I'll just start on that one because we actually took some stock in Saracen placement. I think it might have been last week. They raised money at 65 cents. I think they're still 66 or 67. Fat Profits has got a buy on the stock with a valuation around about 85 or 90. Look, it's not a stock I own myself. Probably because, as Kim and Roger have been saying tonight, there's just others in the space that are more standout value. Saracen, Roger, what does it look like to you?
Yeah, it's cheap. It's an A2. It's a reasonable quality company. It's a very good quality company, but more compelling value for us was in Silver Lake and Troy. And what we can see is that the intrinsic value of this company, while higher than its current price, is actually not going anywhere over the next couple of years. We like to buy businesses whose intrinsic value we believe, or we estimate admittedly, is going to rise over the next few years. Troy and Silver Lake are rising substantially over the next few years, whereas Saracen isn't. It's going sideways.
From Melbourne, hi Doug, what's your question for us?
Oh, hello. Thanks for taking my call. The question I've got is with regard to CSL. It's been a sort of a glamour stock for a number of years, but the stock seems to be keeps on falling, even with the weakness in the dollar. So everyone seems to recommend it, but it doesn't seem to go up, particularly over the last 3 or 4 years.
Yeah, look, I think it's a very, very good question. CSL and Cochlear, in a lot of people's portfolios, haven't had the performance, but it's a glamour stock. How are you with glamour stocks, Kim?
I've owned this stock, and I bought it around about, oh God, we're going about a couple of years now, so I would have bought it around sort of $32, $33. I think I sold it about 36. I haven't been back in it, but since. But at these sorts of prices, it looks pretty darn attractive, particularly if you can take a longer term view on where you think the USA dollar cross rate is. I mean, this is a stock that's, you know, that's a pure leverage play to overseas currencies. Also, it's got a fairly dominant position in the markets it operates in, so that's, you know, that's a big tick. Good management. I think going for the next 12 to 18 months, we might see a bit of a resurgence of interest in this stock, because I think the cross rates on the A dollar Aussie are probably going to hover somewhere between 80 and 95, or maybe $1. So at these sorts of prices, I'd be looking at it seriously with a view of getting back into it.
All right, thanks. And Roger, look, probably a bit on both of those, because I think we discussed Cochlear before after the big fall off, and whether that was getting cheap enough finally. Yeah,
it is getting cheap enough. Yeah. So on Cochlear, yes, the answer is it is getting cheap enough. CSL is a business whose its shares are trading where they were in 2007. But in 2007, intrinsic value was about $16, and now intrinsic value is closer to $30. And so what we've seen is intrinsic value double, and the share price is back to where it was in 2007. So I like both of these businesses. Cochlear has enormous competitive advantages, great reputation, which hasn't been sullied by the recall. Every analyst was concerned that there would be, or almost every analyst was concerned that there would be brand and reputational damage as a result of the recall. But when you look at Advanced Bionics, they had a recall as well only a year ago, and their product actually caused pain and suffering in their patients as a result of their fault. That's not been the case here. I think what we've seen in Cochlear is a preemptive step. I spoke to one clinic that fits the Cochlear implants. They've fitted over 2,000 implants over the years, and since 2009 they've fitted 540 of this particular implant that's been recalled. Out of that 540 implants, 2 have been faulty. So yeah, this is really a preemptive move, and I think if anything it enhances their reputation. Going back to CSL, because they're in the Southern Hemisphere, if there's a swine flu epidemic or a bird flu epidemic in the Northern Hemisphere, then being in the Southern Hemisphere gives them enormous competitive advantages to actually prepare what they need to prepare in order to service that country better than anyone in the Northern Hemisphere. So I think these two are Class A businesses. They're some of our best exports that we've got listed on the Australian market. And you know, they're A1 businesses, always have been, and finally they're cheap. People are looking at the share price, scratching their navel and saying, gee, I wonder if it'll go down anything lower.
Welcome.